Hello everyone. So the next part is financial ratio analysis. Financial ratio analysis is applying analytical technique to financial statement of the organization of any business to the relevant data for the production of information for the particular decision making. The main focus of financial analysis are three issues. One is profitability, another one is liquidity and safety. In safety, we generally involve solvency risk. In general, each financial ratio is closely related to one of the another three fundamental issues. Here is the balance sheet of the particular company. The information of current year and the comparison between last 2 years given data. In current asset, it includes cash and cash equivalent, trading security, account receivable, inventory, investment available for sale, fixed asset, property, plant and equipments, less accumulated depreciation. Goodwill, total asset, current liabilities, accounts payable, notes payable, accrued and other liabilities, total current liabilities, and in long-term debts, it includes bonds and notes payable, total liability. In stockholder equity, it includes common stock, additional paid-in capital, retained earning, total equity, and total liability and equity. Here is the income statement of a GI company, that is General Insurance Company. Sales 1 lakh 18 lakh, cost of goods sold 10 lakh, gross profit 8 lakh, operating expenses 4,86,697, depreciation and amortization expenses, that is your 13,303, net income before income and taxes, that is 2,90,000, income tax as per the given data 31%, that is your 90,000, and net income after income tax, that is your 2 lakh. Earning per share, operating cash flow, dividend for the year, market price per share. Here is the formula: working capital, current asset minus current liability. According to we have already seen there is a balance sheet. In balance sheet we have given data. On the basis of that data we are calculating our working capital, and the formula for working capital is current asset minus current liability. First we are solving working capital of year 2, that is your 7,15,000 minus 6,95,000. So the first year working capital is your 20,000, and year 1, that is your 6,65,000 minus 7 lakh, and the working capital of that year is 35,000. Here we need to calculate current ratio, the slash working capital. The formula for that is current asset upon current liability. Year 2, 7,15,000, 6,95,000 upon, that is the ratio for that particular year is 1.03, and the year 1, that is our 0.95. The industry average ratio, we generally consider an ideal ratio for industry is 1.5. So this ratio indicates that general insurance ability to meet its short-term borrowings obligation has improved and is low compared to the industry average ratio. Here is the acid test ratio. The formula for calculating acid test ratio is cash equivalent plus market security plus net receivable upon current liability. So year 2, here it is 50,000 cash equivalent, 75,000 market security and 30,000 net receivable upon current liability, that is your 6,95,000. So the acid test ratio for that particular year 2 is 1.03, and year 1, 35,000 plus 65,000 plus 2,90,000 upon 7 lakh, and the ratio of acid test ratio is 0.95. So here in acid test ratio, industry average ratio is 0.80. It indicates that the industry average of 0.80 is higher than general insurance ratio, which indicates that general insurance have trouble in meeting their short-term needs. Next is our cash ratio. The formula for cash ratio is cash equivalent plus market security upon current liability. Year 2, that is your 50,000 plus your 75,000 upon 6,95,000, and the ratio for that year current cash ratio, that is your 0.180. And year 1, that is 35,000 your cash and cash equivalent, and 65,000 is your marketable security upon current liability, that is your 7 lakh, and year 2 ka cash ratio, that is your 0.14. Moving to next, account receivable turnover ratio. The formula for calculating account receivable turnover ratio is net credit sale upon gross receivable. In question we have given data, net credit sale is our 18 lakh and gross receivable is our 3 lakh, and that it indicates 6 times. This ratio indicates the receivable quality and indicates the success of the firm is collecting outstanding receivable. Faster turnover gives credibility to the current and acid test ratio. Now the next is accounting receivable turnover ratio. We calculate on the basis of days. In days, the formula, that is gross receivable upon net credit sale upon 365 days. 365 days slash receivable turnover, that is our 60.83 days. It also, this ratio indicates that average number of days is required to collect account of receivable. Next, that is our inventory turnover ratio. In inventory turnover ratio, we calculate on the basis of given data. We have seen the formula for calculating inventory turnover ratio, cost of goods sold upon average inventory. We have given 1 lakh as COGS upon average inventory is our 2,90,000, that is 3.45 times. This measures how quickly inventory is sold in any organization, and it is a good indicator for an enterprise performance, that the higher turnover in general, the better performance for that organization. Next is inventory turnover in days. Inventory turnover days, here is the formula, average inventory upon COGS slash 365 days. 365 days upon inventory turnover. 365 days upon 3.45, that is our 105.80 days. This ratio indicates that average number of days are required to sell the company's inventory. Moving to next, operating cycle. The formula for calculating operating cycle is AR turnover in ratio plus inventory turnover ratio in days. The 60.83 days plus 105.80 days, that is our 166.63 days. The operating cycle indicates the number of days between acquisition of inventory and realization of cash selling that inventory. Next is our working capital turnover. Formula for calculating working capital turnover is sales upon working capital. In question, we have seen sales and working capital data has been provided to us, that is 18 lakh minus working capital. The formula for calculating working capital is current asset minus current liability. So here it is 7,15,000 minus 6,95,000. So we will get our working capital turnover ratio, that is our 90 times. This ratio indicates how effectively working capital is used by the company. Next, return on total asset. Net incomes upon total asset. Net income is our 2 lakh and total asset is 2,16,500. That is our, the data is 7.65%. Gross margin. The formula for calculating gross margin is sales minus COGS. In question, we have given sales, that is our 18 lakh and COGS is our 1 lakh. So we will get 8 lakh as our gross margin. Next, gross margin percentage. Gross margin upon sales, 8 lakh upon 18 lakh, and the percentage, that is our 44.44%. This ratio is a good indication of how profitable company is at the most fundamental level. Companies with higher gross margin will have more money left over to spend on their businesses operations, such as research and development, marketing. Marketing play an important role in any company's image. The next one is net profit margin. The formula for calculating net profit margin is our net income upon net sales. Net income is our 2 lakh and net sales is our 18 lakh. So here we will get the answer 11.11%. This ratio indicate profit rate when it is used with asset turnover ratio indicates the ratio indicates rate of return on asset as shown in below. Next one is our operating margin. The formula for calculating operating margin is operating income upon total sales. Here operating income 8 lakh minus 4,86,697 upon 18 lakh. So here you will get the answer, that is our 17.41%. Operating margin is the measurement of what proportion of a company's revenue is left over after paying all the variable cost of production such as wages, raw material, etc. A healthy operating margin is required for company to be able to pay his fixed costs such as interest on debt. The next, that is our total asset turnover. The formula for calculating total asset turnover is net sales upon total asset. Net sale is 18 lakh and total asset is our 26 lakh 15,000, and the answer is our 0.69 times. This ratio is an indicator of how our general insurance company makes effective use of our asset. A high ratio indicates effective use of asset to generate sales. Next is 0 point return on investment. The formula for calculating it is net income upon total asset. Net income upon total net sales into net sales upon total asset. So here 11.11% into 0.69 times, and the answer is our 7.67%. Note this that ratio is used to both net profit margin and total asset turnover. These ratio allow for increase in analysis changes in the percentage. The net profit margin indicate percentage return on each sales, while the asset turnover ratio indicates that effective use of asset for generating our sales. The next one is our return on investment. Return on investment, the formula for calculating return on investment is our net income plus interest expenses 1 minus tax rate and slash long term liabilities plus equity. In question we have given data for, that is 2 lakh plus 10,000 minus 1.031 upon 6 lakh 50,000 plus 1 lakh 27,000. The answer we got 0.11 times. Our ROI measures the performance of the firm without regard to the method of financing. The next are return on common equity. The formula for calculating return on common equity, that is our net income minus preferred dividend upon common equity. Net income is our 2 lakh and preferred dividend is our 0 upon 12 lakh 70,000 is our common equity, and the answer is 15.75%. Next method, that is our debt equity. The formula for calculating debt equity ratio, that is our total liability upon common stockholder equity. In question we have saw the data. There is the comparison on the basis of 2 year, that is you have given 1 year ka data and another for the comparison, that is 2nd year ka data. In year 2, that is our 13 lakh 45,000 upon 12 lakh 70,000, and the answer we are getting 1.06. The comparison for first year ka data, that is 13 lakh upon 11 lakh 50,000, and the answer we are getting 1.13. This ratio indicates the degree of protection to creditor in case of insolvency. For example, if any company is insolvent to pay our debt, so this ratio is providing shelter for that particular creditor, those who are insolvent, those who are not able to pay their debt on time. This ratio is the better for the company's position. In case of general insurance company, the ratio is very high, indicating the majority of the funds come from the creditor. Generally, creditors are those people who lend us money for the growth of our company's financial position. However, this ratio is improving. Debt ratio, total liabilities upon total asset. Year 2, 13 lakh 45,000 slash 26 lakh 15,000, and the answer we are getting, that is our 15 lakh 4%. first year का comparison 13 lakh upon 24 lakh 50,000, and the answer we are getting, that is our 53.1%. This ratio indicates that more than half of the assets are financed by the creditor. Generally, it indicates that the whatever the fund that is a company is using, that is providing by our creditor. So creditor is the main person who is helping our company. Next, times interest earned. The formulas for calculating time interest earned is returning income before tax and interest upon interest. In question, we have given data 2,90,000 plus 10,000 upon 10,000. The answer we are getting, that is our 30 times. This ratio reflects that the company's ability to cover all the interest charges. It uses income before interest and tax to reflect the amount of income available to cover interest expenses. Generally, company is covering their whatever expenses on interest they are paying with the help of this ratio. The next is our operating cash flow or total debt. The formula for calculating operating cash flow, that is our operating cash flow upon total debt. In question, the data has been given, that is 2,55,000 upon 13,45,000, and the answer we are getting after calculating, that is our 18.96%. This ratio indicates that company is able to cover total debt with a yearly with a cash flow. The next is operating cash flow ratio. The formula for calculating operating cash flow ratio is cash from operation upon current liability, that is 2,55,000 upon 7 lakh, and the answer we are getting, that is 0.36. The purpose of this ratio is to assess whether or not a company's operation are generating enough cash flow to cover its current liability. If this ratio falls below 1.00, then the company is not generating enough cash to meet its current commitment. The cash from operating activities, that is our 2,55,000, show at the bottom of the income statement. Here EBIT full form, earning before interest and taxes. The formula for calculating earning before interest and taxes is earning plus interest expense plus tax expense. Here 2 lakh plus 10 lakh plus 90,000, that is our 3 lakh. A measure of company's earning power from ongoing operation is equal to earning before its deduction of interest payment and taxes. EBT exclude income and expenditure from unusual, non-recurring or discontinued activity. Here the next one is EBITDA, earning before interest and tax and depreciation and amortization. The formula for calculating it is earning plus interest expense plus tax expense plus depreciation plus amortization. Here 2 lakh, 10,000, 90,000, 13,303, and the answer is 13 lakh 13,303 rupees. This earning measures is a particular interest in case where companies have large amount of fixed assets which are subjected to be heavy depreciation charges, or in case where a company has a large amount of acquired intangible asset on its book and thus it is subject to the large amortization charges. Since the distortionary accounting and finance effect on both the company's earning not in a factor into the EBITDA data, it is a good way for comparing companies within across the industry. Thank you.